Welcome to Investing Insights. I'm your host, Ivana Hampton. Emerging market funds will have a tough act to follow in 2026. The category racked up big gains last year, following small returns for years. And a mix of factors like trade tensions prompted many investors to shift their dollars outside the U.S. Should you add emerging market funds to your portfolio? And which ones were winners or losers? Morningstar Senior Principal of Ratings, Russ Kinnel, dug into the data. The editor of the FundInvestor newsletter is here to tell you what he found. It's good to see you, Russ.
Good to be here.
Well, fortunes have reversed for many emerging market funds. Many of them closed out 2025 with their best year in a decade. What made the environment right for their outperformance?
There were a few things that came together. One is simply that they'd had a long time of slow performance, so they were kind of due, they were kind of cheap. Another thing was sort of a sell America trade. As the dollar went down, people were down on the U.S. in part because of tariffs. And finally, you just had some good growth stories happening too.
And there has been a big shift in 5-year performance tables after 2025. What happened, Russ?
That's right. So last year was so big that it really rearranged the leaders tables, not just for last year, but for the 5 years. And I would say that the biggest themes is that value came back strongly, and there were some funds that owned U.S. stocks that had emerging markets exposure, and that U.S. exposure worked really well until last year, when obviously they didn't benefit from the falling dollar and other things. And so the more pure emerging markets funds really came to the fore last year and are now even ahead on the 5 years in many cases.
You wrote in Morningstar FundInvestor that India went from an emerging market star to a dud. Why and how has that benefited China, South Korea, and Taiwan?
Yeah, so there are a few factors. I don't know that any one is the main driver, but there was trade tensions with the U.S. That didn't help. Two, I think India, because it had been the darling, emerging markets tend to have rather violent market shifts of leadership, and I think that was just one of them. Is kind of collectively the market said, India's done, and let's look elsewhere. And then finally, there were some disappointing earnings coming out of India.
Now, with the trade tensions between the U.S. and China, how are asset managers managing China in their portfolios?
Well, China came roaring back last year, in part because, again, I think we've had trade tensions with China for a while, and people are saying, well, China's pretty resilient, and some stocks just looked really cheap to investors, and so China came back, and again, the weakening dollar helped that too.
Now, you have identified emerging market fund winners and losers of 2025 and December's FundInvestor newsletter. Let's start with Lazard Emerging Markets Equity. What's the story there?
Yeah, they've got a bit of a value tilt, but what's interesting is because value became, even tech names became cheap, so they had some winners in Chinese tech names. It also helped that they were overweight China and underweight India. That's a very common theme. If you look at the winners, overweight China, underweight India, and the losers, it's the other way around.
Let's keep going down the winners list. A couple of funds have a value focus, but their managers bet on Asian technology stocks like Alibaba and Taiwan Semiconductor. How has this strategy paid off for Dodge & Cox Emerging Markets stock and Causeway Emerging Markets?
Yeah, so names like Alibaba and Tencent ended up in these value-oriented portfolios, in part because they're cheap, at least on their measures. And interesting, both of these funds have quantitative elements, and so they have a disciplined quant screens. And so if a name that considered growth shows up there, they're gonna buy it if it looks attractive, even if it's a tech name. And so that really worked well for them. But they also had really good stock selection across the board, value, growth, industrial stocks, as well as tech. And so those funds really took off.
Let's pivot to funds that lag the competition. Vanguard Emerging Market Stock Index delivered solid returns, right? So, Russ, this is a case of passive versus active funds. Will you explain?
Yeah, it's not like in large blend, they all fish in a pretty similar pool. And so you tend not to have really big variations between active and passive. But in emerging markets, you've got really dramatically different performance often because the funds can behave very differently. So in this case, two big things factored. One is the index, which Vanguard tracks, has more in India than most active funds. And the other thing is Vanguard tracks an index that does not consider Korea to be an emerging market. And Korea did well. So all the active funds gained on Vanguard because Vanguard didn't have any exposure to Korea.
And there's a rationale that it's reasonable to invest in developed market companies if they're generating significant revenue from emerging markets. You say two funds share this philosophy: GQG Partners, Emerging Markets Equity, and Artisan Developing World. Let's start with Artisan. How did this strategy affect their performance?
Yeah, it helped them a lot until 2025 when the U.S. lagged emerging markets, and it hurt them quite a bit when that reversed. So it really, again, it just shows you what a wide variety there are of emerging market strategies in the active side.
And what additional factors limited the returns of GQG fund that I mentioned? And you own that one, right?
Yep, I own it, and so I managed to participate in one of the poorer performing emerging market funds. But Rajiv Jain had been a really big believer in NVIDIA, and up until early 2025, when he really pivoted and thought AI is overdone, and so he sold all of his NVIDIA. So if he had held on to that, then he might have been able to overcome the big U.S. weighting, but instead, he couldn't. So his timing, at least in the short run, was off because NVIDIA ended up having a very good year.
And what could the reversal in emerging markets performance mean for their ratings for Morningstar?
Well, on the fundamental medalist side, it probably won't affect them too much because we're looking at the long term. A lot of the funds that did really well, we already had medalist ratings on. Some of the ones like GQG that we had. We also that did poorly. We also had medalist ratings on, and I don't think their fundamental long-term outlook necessarily changed. Now, the star ratings, of course, are based purely on past performance, and so we're definitely going to see some of these value funds pick up stars, and some of these growth or U.S. heavy funds lose some stars.
Why do you think investors should consider adding emerging market funds to their portfolios, and which bucket that suits these type of funds?
Yeah, so emerging markets are a good diversifier. I think last year showed that they behave differently, and there are some really important markets. Whether you count Korea or not, you still got China and India, some huge economies that are with some dynamic companies, and so I don't think you want to miss out on that. So they're good diversifiers. There's some good growth potential there. There are heightened risks on a number of levels, but it usually works out okay. So I guess I would put this in. It's not quite speculative, but I wouldn't make it a core holding because they are very volatile. Look at the last 10 years of returns, and you'll see many years of poor returns and then a huge year like last year. And that's certainly possible for the next 10 years. So I think it's useful, but you want to keep it a modest amount because they are higher risk.
What's the outlook for emerging market funds in 2026, Russ?
Well, the dollar's continuing to fall, and that certainly helps. And because emerging markets had been out of favor for so long, I think there's certainly potential that that momentum continues for a year or two more. Not that I'm a great predictor of the next few months or anything, but I think there's still a pretty good case for emerging markets.
In that case, I would ask you about the upcoming baseball season, but we'll leave that for another day. What's the takeaway for emerging market funds following their big rally?
I think just it's a reminder that these really do have potential, that it doesn't make sense to throw them out and ignore them just because they have a bad stretch. So I think you want to participate, even if that's in a small amount of your portfolio.
Well, let's pivot to some big news that came out within active management. Fidelity Contrafund manager Will Danoff has announced that he will retire at the end of the year. Can you talk about how Danoff succeeded against his competition and in different market environments?
Yeah, Danoff is one of the all-time great investors. Just look at not just his long-term record in which he crushed his benchmarks and peers, but also in the short term, year on year, you see he really suffered significant underperformance versus peers or benchmark. And he did maybe the best job of anyone of managing that fire hose of information. If you're at Fidelity, you've got input from hundreds of analysts, thousands of company visits, scores of companies coming to visit every day. That's a ton of information to take in. And Danoff loved all of it. So he loved visiting companies, talking to analysts. He loved finding out where's the real growth. How is technology changing? More recently, he's done well with names like Meta and NVIDIA, but he really just thrived in all that and was able to put all that to work in a huge strategy with over $100 billion in assets, and so I think that's really remarkable. And he really, even though he was focused on the long term, on a single year basis, he didn't want to lose out. So if he felt this is the year for financials or some other value industry, he might go there. He very much was focused on building that long-term record with good year-to-year success, and I think just did a remarkable job of thriving in even with a huge asset base.
That sounds like a lot of unique qualities. Will there be another active manager like Danoff again?
Probably, at least one somewhat similar. So I think there's still, as he has shown, there's still room for active managers to succeed. Will they be as famous? I don't know, but I think there's still room for them to succeed. It might be a little different. Obviously, the way you add value with investing changes every day as innovation alters the way things work. But I think there still will be room for the Danoffs of the world, and certainly there will still be some really good investors.
So Danoff's two co-managers will take the reins. Who are they, and what do they bring to the table?
It's Asher Anolik and Jason Weiner, and they're experienced managers who've worked with Danoff and were kind of clearly the heirs apparent on this fund. And so I expect they will continue to run it in a growth strategy. I think they can try to be true to Danoff's strategy. Now, they're human. They may not do as well as Danoff, but we think they're pretty good, and I think the fund still has potential.
They'll have some big shoes to fill, right?
Absolutely.
So what are some lessons everyday investors like me can learn from a legendary stock picker like Danoff?
I think one of them is simply keep that curiosity. He was always interested, always engaged. He didn't, do well for a few years and then start to tune it out or try and just keep doing what he had done. He was always engaged, always trying to learn new things, always trying to understand management. So I think that's something we can all take, keep learning, keep trying to find out what's really growing, what are the dynamic industries, because the real innovation doesn't just affect those particular innovative companies, it affect everything. I think the big trends in AI and some other things, whatever Google and Amazon are doing, they affect companies everywhere. And so you really need to understand those innovations, even if you're not going to invest in the biggest tech companies out there.
Well, everyone listening, watching, subscribe to Morningstar FundInvestor. You get Russ's insights monthly. Go to newsletters.morningstar.com. Russ tells me next month's topic is about balance and other allocation funds. Russ, thank you for coming to the table.
Thanks for having me.
That wraps up this week's episode. Thanks for making this show part of your day. And a reminder, Investing Insights is starting a new personal finance series that will help you organize your financial life in 2026. Morningstar's Margaret Giles will host Investing Insights on February 6th and talk with Morningstar's Christine Benz about how to use your IRA to optimize your portfolio following 2025's market performance. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bebel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.